אוקיי. אז קודם כל שלום לכולם שוב פעם, אני אשים את כולכם על מיוט, מי שרוצה לשאול שאלה תרגישו חופשי להוציא את עצמכם ממיוט, והמטרה היחידה של זה רק שלא יהיה לנו קולות ברקע. מאחר וכולם פה מדברים עברית אז אני אדבר עברית, ואם מצטרף אלינו מישהו שלא אז נעבור באמצע לאנגלית, על המזל. שאלה לפני שאנחנו מתחילים, תנו לי פה ככה הגדרה, פחות או יותר, מי פה מכיר יותר או פחות נושא של נדל"ן מסחרי, לא נדל"ן, הרבה מכירים נדל"ן כולכם, נדל"ן מסחרי, את הניואנסים של נדל"ן מסחרי, עשה נדל"ן מסחרי בצורה אקטיבית, לא בתור משקיע פסיבי. כמה יש לנו פה? חבר'ה מנוסים? אוקיי, אנחנו מתחילים בבייסיקס, מעולה. כמובן תרגישו חופשי לעצור אותי ולשאול שאלות. מה אני מחפש? אני מחפש את השיתופי לזה. מעולה. כולם רואים את הפרזנטציה? אני אקח את זה בתור כן, מעולה. הנה חיים. Okay, we are switching to English. We're done with the Hebrew. Chaim speaks English, so we're going to switch to English. Chaim, are you with us?
Yes, yes, yes.
First of all, I'm going to tell you guys something. Everybody that here should get to know Chaim. Chaim is a title guy, but they have a very unique way to do business that benefits, and I'm not doing it because I don't get any money for it, but what he can offer you, you guys are going to be interested to learn about it. So whoever wants after that to communicate with Chaim, let me know. I'll send you contact information. Talk to him and hear what he has to say. It makes life easier, I guarantee it. Saying that, Chaim, that was free commercial, free marketing.
Yes, thank you. I appreciate
10%.
that. We'll negotiate after.
Yeah, 10% of everything. So let's go back. We're going to start. This is a very, I think it's very basic, but also informative in regards to real estate, commercial real estate. They're going to give you the idea. They're going to give you the basics of commercial real estate. Obviously, we can't cover everything, but I wanted to focus on understanding what is commercial real estate, the benefit of it, of course, some definitions. So conversation, when you talk to people, they know what you're talking about, especially in the US, that they have a very specific language for that. And we're going to discuss a little bit financing at the end. And of course, if you guys have any questions, we can discuss the crash or the issue that we have right now with commercial real estate in the US. Again, I try to keep it basics. If you have any questions, stop me. I'll be more than happy to explain it again or to go a little bit into more detail if you like. So let's start. Introduction to commercial real estate. So basically, we split real estate to three major or main type of assets. And the first one will be residential properties, which are properties that the purpose of them are that the owner going to live in one of the units. So maybe you buy a single family to rent it, but that's not the purpose. The purpose of single families when they built them was that people are going to buy and live with them. Saying that under that category, there are, I'm going to say 5 types of properties, which are single, duplexes, triplexes, and 4 families, and condos, which is a unit in a building. Condo is like what in Israel is an apartment. But in the United States, since you can buy a building that have a rental apartments, but it's all one asset, when they break it down to different units so they can sell it, it's called a condo. When we're talking about 1 to 4 families, all the units must be apartments. So let's say you have a store in 2 units, that's not residential, that goes under commercial. So 1 to 4 units, all of the units are apartments and condos, which is like a 1 unit. Questions until here? Okay. So this is when we're talking about residential real estate. So if residential, the purpose of it was to live in it, commercial is properties that we buy in the purpose of making money. Okay? It's a business. It's a business of renting space. Okay? So under that category, obviously goes office building, retail places, industrial assets, hotels, land, and multifamilies. When I speak to investors or people that are less familiar with the language, many times I said, oh, this is a multifamily. They said, but it's residential. So they're mixing the use of the building to the type of the building. So the type is commercial. We're using it for people to live in there, so it's a residential type of units, but it's not a residential property. It's a commercial property. Okay? So when we're talking about multifamilies that go under the category of commercial properties, we're talking 5 units and above. So saying that, we have residential and commercial. What will be the third one? Any ideas? This is a trick question. Semi-trick. It's what's called special purpose properties. Special purpose assets, special purpose properties that are properties that are not to live in, but also you can make any money of them usually. Again, some of them you can do or not. Give me an example, property that it's not for living and not for making money. Any examples? Everybody quiet.
Not making money?
Yeah.
Synagogue. A synagogue.
Exactly. So people of worship, libraries, if it's public libraries, sometimes hospitals, if they are not private, obviously, schools. So this is a type of properties that are there. It's not a business, but at the same time, it's also not for living. Okay, so it's called a special purpose properties. So we have 3 types of properties. And now that we have the properties, and since we are a real estate investor, we want to buy them. We want to understand how much they're worth. And we are talking about 3 value approaches to, of course, in this presentation, we are more interested in how we evaluate or decide what the value of a commercial property. But in general, we have 3 approaches to valuation. And the 3 approaches are comps. Everybody knows comps from residential when we're buying singles or duplexes, right? I'm going to finance, I'm trying to buy it. I said appraisal, you give me a number. It's true that it's mainly for residential, but also when you buy commercial properties, they take it under consideration, so we can ignore it totally. So each type of properties, the main or the heaviest consideration of valuation will be different type of approach. So in residential, it's going to be comps. It doesn't mean that in commercial, we're not using them. When we are talking about commercial, that the purpose is making money, we're going into the income approach. But again, if your income approach going to show a valuation that is dramatically higher than the market, they're going to default also to the comps, and they're going to do some kind of a balance between the comps and the income. Okay? And if I have properties that there is no income and I don't live with them and they are very unique, how many libraries of New York do you have that you can compare? So there is nothing to do comps. We use what's going to be the third one. Replacement cost approach, which is pretty much how much it's going to cost me to build this. So the value of it is how much it's going to cost me versus depreciation, if there is any depreciation to it. I think nobody talked because I speak in English, which is usually what happens when we do this Zooms in English. Nobody talks. Like everybody's like, oh, You guys can, if you have any questions, something, you can write it down and I can answer it, write it, answer it in English. But if you guys not participate, this will go much faster than I expected, which is okay as well, by the way. We can all be done here in like 10 minutes and everybody knows. Questions about approaches of valuation? Give examples. Comps, everybody knows, right? Anybody doesn't know the comps? Yes. Income approach. Okay, so let's go a little bit into the income approach, which is our main way for us to determine how a property, a commercial property is evaluated. And basically,
Hal,
we can have
question.
to, yes,
quick.
sorry.
Don't you always have to look at the comps no matter what way you go?
So I said they're going to give the main weight to the income, but if they're going to see that the income is dramatically different than what's going on in the market, they're going to come and say, okay, let's also look at the comps. They're going to look at it anyway, but they're going to give it a little bit more weight. And oh, so your income and your comps compared to other properties in the area need to match. But let's say, but it also can differ. So it's a very tricky situation. Where do you use that? Because let's say I have a rent control building that all the units are 600, and on the other hand, there is a very similar building, but it's a free market and everything is 1200. Obviously, there is more value there. But if everything in the area is 600 and you say, oh, my leases are 1000 for no good reason, they're going to say, okay, so it can be evaluated that high compared to the market, so we're going to lower it. And in general, they try to bring it into. So I don't know if you guys, we can discuss, for example, what happened to us in Houston, which it seems, I can't say it for 100%, it seems that they forced the value down. It really, when you look at what they did, I can say 100%, but when you look at the method that they used to evaluate the property, it seemed that they tried to force. I made a short video about it in my WhatsApp group. It seemed that they forced the value down on purpose. So,
Tal, I don't understand how they can do comms in commercial.
so
It's not like a one unit versus one unit in the neighborhood. It's totally different.
they try many times to bring it down to the unit level. Okay, so they're going to bring it back many times to the unit level. So they say, okay, this type of property, so you have 120, but this is 100. And per unit, expenses are around $1,000 a unit. The income is around, I don't know, $15 or $2,000. So they're getting an idea on the unit level and they basically project it on your property. So it's not like, I agree with you that it's not like a row of houses that are similar on the same block and say, oh, okay, I know exactly the same square footage. But they try to bring it down to the unit, square foot, or whatever it is, and then project it on your property and come up with more or less. And I gotta say that usually it's pretty accurate because it can be, unless there is something in your specific property or good or bad, by the end of the day, market does its thing, and units are rented around the same numbers, expenses are the same numbers. You don't pay for it dramatically different than the guy next door. Same with taxes, unless something happened there.
But the size,
yeah, and in bigger buildings, we'll discuss it later. Even if you have one tenant that use water dramatically more, it's 100 unit, it's becoming, doesn't affect it that much. Okay. So the replacement approach, we discussed the replacement approach. Replacement approach will be, by the end of the day, how much it's going to cost me to build something like that. That's pretty much the value of it. If I can live with it, it doesn't make any money. Of course, less depreciation. To understand how we came to valuation of commercial real estate, we need to start thinking business. And in business, the purpose of business is what? What is the purpose of doing business?
Making money.
Making money. So we need to start thinking in numbers versus nice kitchen, not nice kitchen, open space, not a space. We start thinking in the money. So people, for example, when people tell me, "Oh, do you like this building?" I like the Excel. Basically, I'm buying an Excel sheet with numbers. I need to I like to look at the properties, but at the end of the day, the property itself, from business perspective, is an Excel sheet. Okay? And to understand the value of that asset that is behind that Excel sheet, I need to know two things. One, what is the NOI? NOI, net operating income, which is pretty much how much this building is make less operating expenses. Okay? How much income, less operating expenses, and what I'm going to get is the NOI, net operating income. I will say here, operating expenses, mortgage payment is not operating expense. So when we're talking about operating expense, we're talking about taxes, we're talking about insurance, we're talking about maintenance, talking about management, stuff like that. Things that are, if I have a loan or I don't have a loan, I have the same expenses to operate the building itself. Okay? Many times I've seen expenses, mortgage payment. That's not, you can do it. By the end of the day, you're going to get to the same number, but it's not an operating it's not an operating expense. The second thing that I'm going to have to understand is what is a cap rate. And a cap rate is a rate of return on a real estate investment. Now I can look at it, what is the rate of return that I want? I can look at it on what is the rate of return acceptable in the market. But by the end of the day, is the rate of return of the real estate investment. And if I'm going to take, and I'm going to say, okay, if I'm going to take the NOI, the net operating income, and divide it by the interest or the return that I want on my money, what I'm going to get is the value. How much do I need to pay for that asset to get this return if I have this net operating income, is net income? Okay? That's basic math. So let's take an example. If I have a building that makes an NOI of $200,000 a year, okay, after everything, I left off with $200,000, and I want to make at least 8% on my money, the maximum that I can pay for that property will be $200,000 divided by 8%, $2.5 million. That is the maximum that I can pay if I want to do 8%. If I want to find what is a return, let's say somebody said, oh, I have a building that makes $200,000 and I want to sell it for $2.5 million. Basically, only as I switch sides in the equation, and I'm going to say, okay, no problem. So $2.5 million divided by $200,000 will give me 8%. This is how I find my return, or what is my cap rate in that deal. Questions? What is the trick here? Where is the point here that many make mistake here? Anybody knows?
Cap rate.
No. The cap rate is something that I determine. I said, I don't want work under 10% a year. How much do I need to pay? Let's call it investment value. The investment value is a cap rate I determine. I said all my deals make 10%. So if I want to go to this deal, I need to make at least 10%. I'm going to determine 10% as my cap rate. What is the trick? Where is people make a lot of mistake? Determine what the NOI is. Okay, the NOI is a trick to that, to calculate the right NOI, because there are two main problems with the NOI. One is the income, and the second is expenses. Is my income is right? What happened many times, and I saw it so many times, people say, oh, this building make $8,000. Why? They sold leases that make $8,000. They buying the building, finding out that there is leases for $8,000, but tenants are not paying, and they actually collect only $5,000. So now their net operating income, the actual one, not the paper one, the actual one is much lower than expected. So when you're buying a building, and I do it in all of my contracts, I ask to do two things. I ask to see two things. And by the way, banks do it as well today. So I want to see all the leases, but I also want to see all the deposits. I want to see that there is a match between how much the leases are and how much you actually collect. Not 1 month, because it can fluctuate a little bit. But let's say 3 or 4 months back, let's see how far are you from the leases itself. And if it's dramatically, you know that there is a problem. And if it's not, there is always something. So you're like, okay, I'm in the bulk number. I know that I'll be okay. I need to adjust a little bit here and there. Okay. The other problem, not from the income perspective, the other side of it is expenses. Underestimating expenses. And find out later on that, oh, now I need to pay that, and I need to pay that, and I need to pay that, and I need to pay that, that I didn't took into consideration, and you end up with a lower NOI that you expected. So we need to be very, very careful with the expenses. A lot of it is experience. There is the basic stuff, taxes, insurance, but the thing that where we miss is gardening, shoveling snow, stuff like that, that if you don't think about it before and you find out later, when I take a management company, does they shovel? Let's say I have a big parking lot. Who shovel the parking lot? Can be a big space. Is that included in the management? In that on top of it? So all this stuff, gardening, stuff like that. So we need to keep that into consideration and making sure that when we list all our expenses, we're actually doing it properly. We do cover everything. And of course, at the end of it, to add some room for mistake. I want to have cushions. Okay, questions?
I have one question.
Sure.
When you try to look for a commercial resident like this, and you look at the paper or a report, what do you look for? What do you get? You get the cap rate, you get the the NOI, and then you calculate it, or then you get the reports and you calculate the NOI by yourself. How is it?
That's a great question. I'll tell you. The two main things that I'm looking when I'm looking at a deal, okay, either I saw it online or somebody sent it to me. I'm trying to look at two things. The first and most important one is the rent roll and expenses. I take the rent roll and the expenses. I do a quick general kind of a thumb rule calculation based on my returns. So, okay, I want to make 20, whatever it is. And I see what numbers come out. I don't even care at this point how much the owner is asking. It's like, for me, this is a $3 million deal. After I have this number, I'm going to look at the owner and see what he's asking. If I want to pay $3 million, and I'm not saying it's impossible. I think it's like out of experience. And he wants around 4 or 4.5. In my feeling, there is something to discuss. I'm at 3 and he's 4, but it's not that far. If I'm at 3 and he's at 15, I'm not going to even bother. This is not a reasonable seller. It's okay for a seller to try to push the price, but I need for me not to feel that I'm wasting my time, that there is some type of a logic to his request. We can disagree on the cap rate, but to come at the market is at 6, and I see deals that are at the beginning. You saw it a lot, by the way. At the beginning of the crisis, you saw it a lot. That people was like, you can get a loan under 7.5%, and people are trying to sell properties at cap rate of 4. Double what the market is. Like, this is not, you're not realistic to what's going on. Okay. But for example, the deal in Houston, it was at 10.5 million, and I was at 9.5, and we got the deal done. Okay. It took a little bit of time, but we got it. So it was the same. It was a 10-15% difference between where we are, and we made it work.
So what I understand from you, you are like researching for the right NOI. But what about the cap rate? Because there is a difference between 7 and 8 and 5.
Okay, the way that I work Ophir, let's do it like this, because it's gonna. I'll explain to you how I work in general, and I think it's gonna answer all of your questions later on. Okay. And this is a conversation that I had with somebody this week. I will show you, and I'll explain to you how, in general, how I do all my deals. How do I look at all my deals from my perspective? Okay, we'll do it at the end. Remind me. Did you understand the value, how we do the valuation? Okay. Leases for commercial real estate are different than residential leases. Even if it's, we're not talking about apartments that I'm still living there, but we saw that commercial properties, also you're looking at offices, you're looking at industrial, you're looking at retails. So it's a different type of leases. There is a new set of leases that if you never did it, you're not familiar. So let's discuss a couple of them. And the first one is what is as close as possible to residential or an apartment lease, what's called a gross lease, which pretty much the tenant pay the rent, maybe electricity or whatever it is, but the building cost, insurance, taxes, maintenance, stuff like that, it's a responsibility of the landlord. So if we have anybody that have here a property for rent and it's an apartment, probably the definition of what they have is a gross lease. Gross lease. Okay, everybody familiar with that, right? Israel, by the way, it's all gross lease. When we're going into units that are not apartments, then we're going to what's called net leases. Net leases are 3 of them. What's called a single net lease, which is the tenant pay rent and the expenses for the property or portion of the expenses for the properties. A double net, which is rent, the taxes, and the insurance, and the triple net lease, which is from all this is the most common one. The tenant pay rents, taxes, insurance, and maintenance, which means he pay to fix if you have a problem in this unit. I'm not talking about maintenance in the hallway. I'm talking about in the unit, he pays his own maintenance. This is probably the most common lease that you have in commercial real estate that are not apartments. Basically, give control to the tenants to do what he needs to do when it's done. Give the owner, he doesn't need to deal with this stuff. He knows that he gets the rent and that's the end of his expenses. But there is variation to this type of a lease. For example, when I had my office in Brooklyn, which was a triple net lease, but I didn't pay all the taxes. I paid portion of the increase in rent. So the base tax when I got in, he paid it, and I paid to him for every year when it went up, I covered that cost. So there is a variation to that to this, and it's all negotiation between the tenant and the landlord. It's all negotiation. But in general, when you are going and you are either renting it as a tenant or renting it to a tenant, you're looking to do a triple net lease and just drop all the expenses on the tenant, and it requires much less management. So, for example, one of the things, I'm going back to the deal in Houston, the landlord over there, basically what he's doing is he's selling he's a very old guy, so he's selling all his commercial, all his multifamilies, and he's going into triple net properties because he used to manage everything itself, and now that he's older, he doesn't want to deal with it, so he's going to a triple net leases, and the tenant going to take care of themselves. So that is his strategy. Okay? There is another type of commercial lease, which is a percentage lease, usually in retail. And in that case, basically, there is a base rent, usually lower than market value, but then the store pays the landlord a percentage of the sales. The advantage of this lease is that it reacts to the market. So let's say you are a retail and you have only base rent, and for summer there is a recession, sales goes down, you are still committed to whatever your rent is in your lease. But if you have a percentage-based lease, you pay a smaller base rent, which help you float, stay in business, and then as market goes up and down, you compensate the seller according to sales. So sales are better, the landlord make more money. Sales are lower, he's making less money, but you keep on floating. If it's done right, it's good for everybody. Because the seller knows that if the market is going to go down, he may be going to get less rent, but he's going to still have a tenant. He's not going to lose the tenant. So we saw in COVID, market was dead. A lot of retail stores, if you guys used to see, I did one block a day. You guys remember that? That I used to go down in the street and look at what is opening, and we saw blocks of blocks, not everything was closed. But if you have base rent, the chance that this happen goes lower. And if you expect that the business that you put in gonna succeed and the market is good, you can actually make more money from renting this way. So it's a good way to do business. Percentage lease. And the last one will be an absolute triple net lease, which the tenant pays for everything. And ask me everything, and I'm gonna say everything. Pretty much hands-off building, usually one big tenant that you just take the building, call me in 20 years, give it back. And until then, you are responsible for everything from maintenance, taxes, just everything. Okay, it's called an absolute triple net lease. Okay? Everybody's so quiet. Okay, let's go. Ignoring the lease part of commercial real estate, there is what do we have in the lease? And when we are doing leasing for commercial real estate, it's a little bit different than residential. We discussed that already. And there is about 10 common things that we're going to want to see in a commercial lease, which of course, one is the duration, usually longer than apartments. Because if I'm building my business in a location, I don't want to think that every year I need to worry if do I stay there, I don't stay there. So usually when we're talking about commercial real estate, the leases are longer, usually between 3 to 10 years. We also discussed the fact that there can be a percentage, so the rent structure. How do we structure the deal? Do we have a percentage of sales? We don't have a percentage of sales. Do we go up? If we go up, how we go up in percentage-wise? Many times there is a renewal option because now it's a business and I want to be able to continue my lease, so my business is going to stay at the same location if I like, usually there is a renewal. So it's okay. And the renewal list can be mutually agreed on, which is, and in any case, but many times there is what's called an option. So it's up to the tenant to decide. So I said, okay, my lease is for 3 years, but 6 months in advance, I have the right to extend it 1 year under whatever the term that we agreed on. But so that give me a year. So even if the landlord come and said, I don't want you anymore, I still have the right to adjust. I have a year to extend it, to adjust, to find a new place if I want, whatever it is. So many times there is a renewal option. Many times it's up to the tenant to decide, not the landlord. Security deposit, usually higher than just 1 month. So it depends on what type of a building it is, depends on where we are. 1 to 6 months. Responsibility for the expenses. So we discuss double lease, triple lease, single lease. So it depends what type of a lease that we are discussing here. And in that, again, we discuss that there is variations. So it's going to be more details on exactly who pays what and how much. Tenants improvement. The idea with tenant improvement is that when I'm renting, let's say I have a store, it's a retail space. I don't really know what will be there. So many times what I'm going to try to market, it's what's called a vanilla box. That's it. It's a box. There is nothing there. But then come a tenant and say, oh, I want to have an office here. And it's going to take me 2 months to build the inside. I'm not even making money. So many times there is what's called a tenant improvement. So I'm giving the tenants either time or a budget or whatever it is to adjust or to custom the space to their use. So many times I'm going to go, okay, you have 2 months, the lease starts now, but you're going to start paying rent 2 months down the road. Or I'm coming and say, I'm going to do the work, and your budget is $10,000, whatever above it, you can do it. So there is different ways to do it, but I'm giving them some kind of a budget or time to adjust or customize the space to their need before they need to start doing the work. So in my office, for example, because when I came into the office, the entire building was under renovation. Basically, we just agreed that I'm going to take possession 2 months down the road, and they did all the work for me. I just told them what I wanted, and it was perfect. So I knew that I have the place. They did the work anyway, so I just needed a couple more walls, so it wasn't a big deal. But they did it for me, and when I stepped in, the office was ready. Okay, but we need to keep that in mind when I'm renting a retail space. Just to come and say, oh, the box is yours, go and start working and pay me rent. You need to be more flexible with that because I'm not making money. Okay? Use clause. Use clause, we have it also in residential, regular residential, but basically it specifies what exactly can be done in that space. But there is aspect to it. And the aspects are, one, as a landlord, what do I want to have there? So I can decide that I don't want any restaurant. Or I want to have a deli. They can make sandwiches, but they can have a kitchen. Kitchen makes smell. Sandwiches, I just cut bread and some cheese, no big deal. So I can be very specific to what I want in the use clause. The other aspect of it is legal use. Not necessarily I can use every space for everything exactly that the tenant wants. So for example, I used to have Chaim 614, 770. What's the name of the avenue?
Eastern Parkway.
Eastern Parkway. So 614 Eastern Parkway. That was my building. 614 was mine. There was an office on the bottom. The CO, the certificate of occupancy, says doctor office. Can I use it for an attorney? The answer is no. Because the CO said doctor's office. So there is a legal side of it. Does the certificate of occupancy,
Is that a big deal to change?
I didn't change it because you know what happened? A week after I bought it, a doctor came and said, sell me the building. A week after I bought it.
Wow. But
And I bought
typically,
it for
it's a big deal to
1.3.
change it's not zoning, right?
What? Yeah, it's a change
Zoning
of,
is
it's a change of use. You need to bring it up to code. So I
code,
didn't
right.
want to do it, and I got lucky because a week after, a doctor came and says, "Sell me the building." It's a building that I bought for 1.3 and a half, with 90% seller financing, and I signed a contract. I swear to God, it's a true story. I signed a contract less than a month later for $2 million. And we went back. We had to wait 90 days to close because that was a deal with the seller. And then 90 days later, we came back and said, "I used all your money," and he almost got a heart attack because his property was on the market for forever for 1.35. He couldn't sell it until I came in. And we did nothing in the property. I think we put maybe $5,000 or $6,000 in it. It was fully renovated. It was amazing. And there is a dermatologist there until now. He's a cool guy, Babka, whatever his name is, something like that. So you need to know also what is your legal limitation to what you can do in that space. I would say when you're doing stuff like that, be very careful with people that need alcohol licensing, because that's an issue to get many places. And then if you're committed to this type of a business and they can get it, careful. What is the other business to be worried about? You guys know? Churches. Banks don't like churches as tenants. So if you buy a building that there is a church in it, or a church come to you and say, "Oh, let me rent it, I want to open a church," you got to be very careful. If it's a big church, like a mega church, that's a different story. But all these little churches that we see, Brooklyn or Queens or all over, banks don't like them as tenants because their income is based on donations. So it's not really an income. Banks don't like it. Be careful with that.
Is it also harder to evict the church?
No, I don't think so.
Same process?
No, I think the same process because again, they're non-profit, but if they don't pay rent, they don't pay rent. The problem is that you go to the bank and you say, "Oh, I have a church." They're like,
But they don't have like special protection or something that they protect churches or something like that?
not that I know of. Maybe specific places they have, but not that I know of. For me, I don't do it just because of banks. The bank look at you funny when you come and say, "Oh, I have a church."
No, I thought banks
for that
don't-
argument as well, but
like that.
synagogue are much less common. But
Right.
all this non-profit that it's come from donation, the bank will, okay, so donation stop tomorrow. What happened then? It doesn't produce income. Assignment on the subletting. This is very important when I'm building a business to make sure that it's very clear why. It's a business. He might decide to sell it tomorrow. And now you have the same business, but a different owner. It's not the guy that you rented to him. So it needs to be clear what happened in cases of assignment or selling the deal, the business, or subletting it to somebody. So that needs to be very, very clear what happened then. Okay? You don't sell your family, most people don't, but you definitely sell your business if a good offer comes around. Maintenance responsibilities. Maintenance responsibility is a funky thing because there is maintenance and there is maintenance. There is maintenance or the toilets are clogged, and there is maintenance that is something specific from the business related. So let's say I have, I don't know, I sell aquariums. So there is a chance of a flood versus the plumbing. So you need to be more specific about the maintenance because it's not a common use like in a regular house. It can be very specific. Do we have heavy stuff in that can fall? Does there is a specific equipment that used that can do damage, stuff like that, whatever it is. So you need to be with the maintenance. You need to be very specific and understanding who does what. Because if you're not, and you're going to say, oh, I had this equipment here and it's heavy and it's vibrating and now I have a crack in the wall and maintenance is on you. For me, that was a regular use. You agreed with me to have this business in there. So you need to be very specific on what you do with the maintenance. And default provision. Default provision, again, you need to be sensitive to the tenants. And if you are a tenant, you need to be sensitive. What happens if the business does not succeed? Okay? Are you releasing them? So for example, in my office, it says that if the business doesn't work or I decide to close it, I need to give them, if I remember correctly, 90 days. And when I decided to close my office, that's exactly what happened. In 90 days, I was released from my contract because we discussed that in advance. What if I want to change location? What if I don't want to do this business anymore? And that's exactly what happened. I decided to close the office and stop working in Brooklyn. So I was released automatically from my list. But you need to ask yourself, if I have a retail or what if the business, let's say you open a new business, there is no, what are you going to force him to be there? You can't do that. You can try, but it makes no sense. So you got to have these options, what's called bad boys cares, whatever it is you want to define it. What's going on if the business doesn't work out? Okay. Questions? So basically, there is two main ways to invest in real estate, in commercial real estate. And I'm going to say there is two ways. Either you buy it in some type of, buy it by myself, I buy it as part of LLC, but you buy it, or you invest in a REIT. REIT, Real Estate Investment Trust. Anybody heard about REIT? Anybody never heard about a REIT? Anybody, this is the first time he hears about a REIT? No, okay, good. So let's make sure what we're on the same page. So REIT is a fund that usually buys rental properties, whatever the type of a property, it's going to be a commercial properties. But it's not like, oh, Tal is opening a fund. It's actually, REITs are traded on the stock market, and there are very specific rules to REITs. And one of the main rules of REITs are that they need to distribute at least 90% of their taxable income to shareholders as dividends. Okay? It's not up to them to decide how much. If this is what they report, they got to distribute it as dividends. And the second biggest advantage is liquidity. So this is a share that is sold on the market. You can liquidate it like any share or stock. And it's not like, oh, I have now a big building that I need to sell and it can take 6 months or whatever it is. Okay, so it's give you liquidity. If this is what's important for you, it's a way to invest in real estate, but keep liquidity. Question about REITs? No. So why even to start investing in commercial real estate? Why don't just keep on buying houses, single families, duplexes? Why not do that? What is the advantage of commercial real estate over? And for the guys or guys, whoever that spoke with me about it, they told you, like, for me, I think commercial real estate is by far more advantage. If I put money already in real estate to do it in a commercial real estate, obviously I need to see and it needs to be the right deal, not every deal, but it's by far superior to buying single family houses. And for me, there are 5 main reasons. One of them is size. And I'm looking at it from the rent perspective. Basically, if I have $100,000 and I put it in a single family house, I have one unit that need to perform that 100%, yes or no. I have a tenant, I have a problem. If he's not paying 100% of my money, doesn't work. If he pays, I'm 100% great. When I come to a building that is relatively high, and when I'm talking relatively high, for me, my limit is 40 and below. I try not to do 40 and below. So 40 and above, rents become diversification. I always hate this word. So basically, I put my $100,000 in a building at 40 units. Even if 2, 3, or 5 of them are not paying, I still have 35 units that keep on bringing income, and I have always cash flow in the building to pay for expenses. Okay? Size. Oh, here we go. We have a mistake here. Size on the expense size limit the relative share of each damage, let's call it, in related to the building. So let's say I have a building that I have as a roof. If the building is 4 floors or 8 floors, the size of the roof is the same size of the roof, and the cost of it per unit goes down based on how many units, more units do we have, okay? If I need to pay for a bathroom in a single family house, there is a damage, it's 1 bathroom on 1 unit. Let's say the cost is $5,000, so now it's a $5,000 on a $2,000 rent. That's 2.5 months. If I need to do it in a building that have 100 units, now we're talking about 5,000 of 200,000 200,000 in rent. So the relative portion of maintenance, heating, insurance many times, roofs, maintenance, management are lower per unit on a bigger building. Does that make sense? Okay. Financing wise, I'm usually going to get better terms than on single family houses. Usually, I'm going to say usually. Now for sure, the terms on commercial real estate are better. Interest rate for everybody is high. If I'm going to bigger buildings, so for example, now on 120 units in Houston, I'm getting my interest rate is 6.1, and it's probably going to go down now because interest rate went down the last couple of weeks. Compared to houses that you are somewhere around 7, I'm going to guess today, somewhere over there. So you're going to get usually better terms on the loan, and you're going to get more tax benefits. So the system itself in the United States, just so you know, want you to buy commercial real estate. So it's built in a way that's going to encourage you to buy commercial real estate. And if you look, probably the most interesting things to look at it will be one, what we are doing, what we did in the Zoom a couple of months ago, what's called a cost segregation, which I can get accelerated depreciation on my property. So I'm going to less, especially at the beginning of the deal, the first 5 years, I'm paying less taxes, increasing my cash flow. You usually don't do it on single families, duplexes. The value is not that high, not high enough. And on top of it, I'm going to get a tax bonus. So when I'm doing it, I'm paying less taxes because of accelerated depreciation, but I also get tax bonus. So for example, Houston, $500,000 in tax bonus. This is not something minor. Talking about $500,000, depending on the size of the deal. And the second part, and it's mainly for Americans, but I'm going to give you an example of how much the system wants you to do it, is of course 1031 exchange. Anybody knows what a 1031 exchange, or I need to explain it?
Can you repeat? I don't remember this.
So 1031 exchange, again, I'm saying I'm gonna it's for an American, but what I'm trying to, the point that I'm trying to make here is to make that the system is built to encourage you to buy commercial real estate. So 1031 exchange say if I'm selling a property, a business, a property, I can defer the taxes on the profit if I'm using the money to buy something bigger, a bigger property. And the time that is deferred is unlimited. It's until I'm going to sell the next building. But if I'm going to sell the next building, the one that I use with that deferred taxes, if I'm going to use this money to buy another one even bigger, I can keep on deferring it forever. When you think about it, basically, the government give you a loan, the deferred taxes, it's a loan. You don't need to pay them, they let you keep it. For unlimited time at 0% interest rate. That's what it is. You're not going to pay more taxes because you deferred it. You pay exactly the same amount that you were supposed to pay, whatever it is. So they give you a loan for unlimited time at 0% interest rate. The system wants you. They say, don't pay us taxes. Go buy something else. Make more money with our money. So I'm getting much more tax benefit, and this is on a personal level, it's efficiency. I'm already searching for a deal. I'm all searching, negotiating. I'm already talking with the bank about the loan. I'm all right. Why to do it on a single family when I can do it on 100 units? It's the same work. It's just more zeros. So from efficiency-wise, how do I allocate my time usefully? It's better to work on something bigger than something smaller because, again, the work is the same work. I just add a couple of zeros at the end. Does that make sense? Somebody ask a question. Sell one, buy another, same. Okay, exactly, yeah. Usually higher value because the point is to use the money that the profit. So it's usually something bigger. But you're right. So we're talking about the efficiency. It's efficiency for me as an investor. How do I allocate my time and get more for the same time of work? So let's talk about commercial real estate financing. And there is a couple of things that we're going to have to understand. Some of the terms, we discussed it in the past, but I want to repeat it. And again, if you guys have any questions, feel free to ask. So the main approach that when we're talking about commercial real estate, the main approach that we're going to use is mainly going to be the income approach. But as Chaim said, and he was absolutely right, we got to look at comps and make sure that we are not way too far from what's going on in the market. So comps come into play as well. What's going on here? Oh, the same mistake. Okay, LTV, loan to value. What is the amount of a loan I'm getting compared to the value? Now, the question is, value is tricky. When I'm buying the property, the value will be the number that was in contract. So let's say I'm buying an $11 million property. There is no argument. It's worth $11 million and I'm buying it for 8. The value for the loan purposes is 8. When I'm refinancing it 6 months after I bought it, the value will be whatever the value is, which will be in that case 11 million. Okay, so value depends on in what is the timing of the financing. At purchase, it's going to be contract or market, whatever is lower. There is another option. I'm buying a 11 million for 11 million, something that worth only 8. So in that case, it's still going to be 8. So it's market, contract, whatever is lower, that's going to be the value. When I'm refinancing, or if I'm financing it more than 6 months after I bought it, then we're going back to market value. Okay, appraiser going to come, I'm going to say it's worth 10 million. That's going to be the value, and I'm going to get percentage out of this value. Usually today is around 70%. Question about LTV? No. Debt service. Debt service, it's whatever the mortgage payment is. Okay, debt service is mortgage payment. So if I'm paying $1,000 for the mortgage, my debt service is $1,000. Debt service coverage ratio is something that is unique to commercial properties. It doesn't exist really in residential properties. And debt service coverage ratio is the ratio between your NOI to your debt service. And usually, the bank wants it to be at least 1.2. So, if my debt service is $1,000, my NOI got to be at least $1,200. It's on a yearly basis, but just. So let's say I say, okay. So if I'm going to come to the bank and I say, oh, but my income is only 11, they're going to lower my mortgage to keep that ratio. Debt service coverage ratio. It's got to be always NOI divided by my debt service, got to be at least 1.2. And if it's not, they're going to lower my loan, even if I have the value. They're going to lower my loan until they're going to hit that 1.2 minimum. That is a very critical thing to understand, because if we discuss after what the reason for the mortgage crisis now, that's one of them. Everybody understand debt service coverage ratio? I'll assume the answer is yes, it's not complicated. And amortization, in Hebrew, luach silukin, is a gradual reduction of loan balance through regular payment. Luach silukin, I pay interest and principal. My principal loan goes down every month. Amortization in English. Luach Spitzer. And a balloon mortgage. A balloon mortgage, there is some confusion sometimes about that. A balloon mortgage is a mortgage that there is a regular mortgage payments, and the last payment is much bigger than the regular ones, and usually covers the rest of the principal owed to the bank. That is another concept, important concept to understand. So let's say I have a single family house. I take a 30 years loan. The amortization, the way that the payments are broken are that in 30 years, I'm going to close that loan. Everybody agree on that? Yes. In commercial real estate, that's usually not the way that it works. So what the bank going to come and going to say, we're going to break your payments like you are paying it for 30 years, but you actually need to pay us in 5. So for 5 years, 4 years actually, and 11 months, you're going to have payments that are like you're paying it 30 years, but the 12 months will be the rest of the loan. And the only way to pay that payment, the only three main ways to pay that payment is to refinance the property, because now you need a big chunk of money. Either refinance the property, sell the property, or if you are very rich, to pay it out of your pocket. Very rarely that this has happened. So usually we are left with two options: refinance or sell the properties. Questions? Everybody's quiet. Okay, so that was our basic understanding of commercial real estate. More, any questions? More. I'm important for me that more understand what we're talking about. She knows better than all of us, but I'm gonna ask. No answer. Okay. Question about that? Real estate financing? No. You guys want to discuss for a second why do we have a crisis in the market? We had a Zoom specific about that, but I can discuss it again. Or give an example. Yes,
I
no?
have I have a question about
Sure.
this. Let's say there is a commercial real estate that they need to return the loan this year,
Okay.
and their debt coverage ratio will be less than 1.2,
Okay.
and they don't generate too much money from this deal. They cannot go to the investors and raise more money, and the bank will not give them refinance, so they go out to the market. Who will take this deal?
It very much depends on the numbers, because if there is still, maybe they can reach enough. Okay. There is two scenarios more or less in what you are describing. One is that the value is still higher than the loan. Somebody gonna buy it. They're gonna be able to close. Maybe they're gonna lose money, but they're gonna be able to close the loan. The bigger problem will be if the situation is so, and I saw it a few times happen, so extreme that actually they don't even have the value there. And then you're talking about foreclosure, or at least what's called a short, not a short sale, but a short payoff, which you go to the bank and say, listen, guys, let's be honest, there is no way to cover this loan. Agree to take less, and let's call it a day. And sometimes the bank gonna say yes. But in general, what you are describing is some type of a sale of the property, because that's going to be your only option. In the last couple of years, people lost a lot of money this way. Yeah, let me give you an example. Not going to explain the market, and going to explain. So let's say the year is 2020.
I just want to add another issue here. What if the investors have 8% preferable interest?
Doesn't matter.
It doesn't matter. They will not get it.
If they lost the money, they lost. This is a point of being an investor. Good or bad, ownership. So if all the owners going to lose, you're going to, again, it depends. Maybe you have whatever leftovers, you get it before the GP, maybe you're going to get something. But in general, if the deal doesn't have equity and you're one of the owners, you're going to lose your equity. Part of the deal. This is part of the risk. This is why when you do this, when you evaluate, and this is something that many people didn't do going back 10 years, like what if the market gonna turn on us? And I remember this conversation from 2 or 3 years ago, like, oh, the market never gonna happen. It's never gonna be 2008. The market is there is so many properties that are, and look what happens now. People tens of millions of tens of billions of dollars just wiped in real estate, in commercial, not in private houses, different story. So let's say the year is 2020. I have an NOI of $100,000, right? The market cap is 5%, which was a common, okay? I have amortization. I have a value. What will be the value? Come on. NOI divided by cap rate, right? Right? So I have a value of $2 million. My LTV, which was very common at the time, was 75%. What will be my loan? Come on, guys. 75% of 2 million.
1.5.
1.5. Okay. My interest rate. What was the interest rate? 2020. 3.5%. Amortization, 30 years. Term. How far do I need to close the loan? In 5. Okay? What will be my payment? Let's see. I'm gonna try to force the numbers to work just to give you an example. But let's say I think we're gonna be very close. I want you to show you something that. So PMT, you guys know how to use PMT? PMT will calculate for you the payment. PMT. So we have the rate. Our rate, we know what the rate is, at 3.5%, right? Net present value. We're going to do it 30 years. And present value of the loan is $1.5 million. And we have $81,000 a year mortgage payment. Debt service coverage ratio will be 1.2. That's an excellent number for us. Okay, can I get the loan? The answer is yes. Everything is okay, 75%. I have the debt service coverage ratio. Everything is great. Year passed, we got to 2024. Okay. Let's say my NOI went up how much? 3%? '21, 2022, 2023, 2024. Now my income is 103. Oh, why did that? I apologize. My income is now went up 3% every year. I'm at 100,012. What happened to the cap rate? It went. It's around 7 now. What is my value? $1.6. I just lost $400,000.
Why the cap rate?
Interest rate went up, cap rate went up.
Mm.
Okay, but let's say I still have only $1.5 million loan, even a little bit less because I paid it for 5 years, right? So maybe I need. How much money do I need to pay $1.5 million loan? Let's say it's 1.450. Okay, that is my goal. Like clear 1.450, right? I need 1.450. That is the net. But to take the loan cost me money, right? Gonna cost me money to take the loan.
Mhm.
So I'm gonna need at least 3% above it. At least 3%. At least that is the minimum that I need is 1.5, more or less. Okay. LTVs, now the bank is worried. The LTVs that the bank is willing to give are only 70% now. What will be my loan? So I'm already in trouble with the LTV. Okay. Interest rate went from 3.5% to 6.5%. Term will stay the same. My payment right now will be rate 7%, net present value 30 years, net value 1.2. I'm $500,000 short. Not $500,000, $300,000 short on the same property. That actually income went up. And that is basically the problem with the market now. So now the question is, how do I close this gap? So if I sell it now, I can sell it for 1.7. I paid $2 million for it. I'm going to lose $300,000. That is investors' money. Or my
Tal,
money.
why you are short? Why you are short again?
Because I can get, there is two problems that arose. One, the LTV is lower today than it was 5 years ago. But even if I'm going to keep it at the same, okay, you see that I already got a loan that is lower than what I need. But you see also that I don't have the debt service coverage ratio. So the bank gonna say, oh, you can get 1.29. We're gonna give you 1.22
Mhm.
to keep the 1.2. So you're still $300,000 below.
Yeah.
You got to keep that debt service coverage ratio. So now you can sell it for 1.7 because the buyer that's gonna have the same problem. He's gonna say, listen, dude, the fact that you pay $2 million for it 10 years down the road, that's not my problem. Right now, the value of it is 1.7. If you really want to sell it, you're gonna have to sell it for that price. That means that you're gonna lose about $300,000 out of your money because the bank need to get paid. The bank doesn't care. Now, in that specific scenario, you have a problem with the bank as well because you had a loan of 1.5 and it's 1.2. So here you're going to have to discuss that even a little bit more complicated. But let's assume that you have enough gap. It's only your money. This is a foreclosure property. I saw the most extreme situation that I saw was a deal in Texas, 1,000 units, that the original valuation was 104 million. The loan was 65 and the bank wanted 35. Like they wiped $30 million out of their pocket.
Yeah, but the key issue here also is the cap rate. If it goes lower because they're going to
The cap rate goes together with the market. So interest rate goes up, cap rate goes up. Because people say, oh, why do I want to buy real estate? You need to understand that when I am investing, it's what are my options in the market. So if my option in the market is to give it to buy whatever it is and put it in the bank for 6%, why do I want to risk it in the market for 6%? I want to risk it in the market for 12%. Values go down. Now I can pay less for the same property. If the interest rate was very, very low, so okay, I can 3%. If I put in the bank 3%, if I buy real estate, 6 is enough. So valuation goes up. Interest rate goes up, valuation goes down.
But now the market is in a period that the interest rate wants to go down by the end of the year, so it might release some pressure, no?
Everybody wants. When they started it, I said it's going to take longer than expected. We are at longer because if you listen to a conversation from a year ago, say, oh, they're going to drop the interest rate, and they stopped doing it. Now they're saying, oh, we're going to do it again, and then Donald Trump came and doing what he's doing, and people are worried about inflation again. Not necessarily that they're going to lower it. If they're going to go into so nobody really knows, and this is the point that everybody needs to understand. Nobody knows what will happen. You can operate almost basically what you know today. What happened tomorrow? You hope that it works on your on your behalf, but you don't really know. So you got to. The point of what I'm trying to say is you got to understand that it can be either way. And when you analyze a deal, you have to ask yourself, what will happen? Not just if interest rate is going to go down 5 years down the road. What if it will go up? What happened in the last 10 years, most of the people that look at deal said interest rate either going to go down or going to stay the same. And it flipped on them. Questions? Everybody cool?
I have one question. So, if we go to the worst case scenario, that the value is much less than the loan, and no one is going to buy it, we go for foreclosure.
Yeah.
If you go to foreclosure, what next? They sell
Auction.
it to who?
We're going to auction.
And who will take it? It's a bad deal.
No. Once you do it, it's been foreclosed, that's a different story. Okay, so let's explain how foreclosure going to go. How foreclosure works on a property like this. Basically, the bank going to go back to going to go to court and say, listen, he's not paying his mortgage. I want to take over they don't take over the property. We want to foreclose. We want to liquidate the property. The bank gonna put a receiver. It's called a receiver. Somebody that's gonna manage the property until a decision will made. They're making a decision, so somebody is managing the property, collecting the rent, whatever it is. And now, assuming that the bank gonna win, it's gonna go to an auction. The court gonna auction the property. So the bank gonna say the minimum that we are willing to take will be $10 million. So it's gonna go to an auction, and if somebody will, and the bank understand now in that point there is insurance and all of this stuff. So if somebody come and said, okay, we are willing to pay $10 million, they're gonna sell it in the auction, and gonna sell it in the auction and the bank gonna take whatever the $10 million that they need to get paid. And if there is leftovers, that's gonna go to the owner. Assuming nobody buy it in the auction, basically what will buy is going to become the ownership will be transferred to the bank's name. That's what happened in 2008 many times. Now, the bank, only in that point, after the auction, if nobody bought it, only then the bank become the owner, and the bank going to bring it back to the market. Now the loan is wiped. There is no more loan. So now they can sell it at market value. So whatever the market is. Okay? Any more questions in Hebrew, in English, Spanish, Amharic? Nothing. Okay. If this is the case, guys, I want to thank you again for coming. I'm going to upload this to YouTube. So if anybody wants to take a look at it later on or forward it to somebody, no problem. I will send everybody a link. And I hope you enjoyed it. I hope you learned something. And if you guys have any more questions, let me know. I'll be more than happy to answer.
Thank you very much.
Appreciate it, Tal. Thank you so much.
Thank you, guys. Have a great day.